Yeah, thanks, Matt. And the point is that concentration risk is still really elevated, especially in the domestic equity markets. You've got the top 10 stocks in the S&P 500 that still make up about 38% of the benchmark. Tech is still the biggest sector by far. If you were to combine the seven smallest sectors, it would still be smaller than the tech sector is alone. So we're highly concentrated in a handful of stocks and a handful of sectors. So you really do need to be deliberate about diversification because it's really not adequate at the index level. And I think the first quarter has already been instructive in terms of diversification being a tailwind. You had the January through February period where leadership was predicated on lower inflation, lower interest rates, and a weaker dollar. We saw leadership from the value style, from small caps, and from international markets through the first 2 months of the year. Then we had the conflict in the Mideast breakout in March, and that leadership flipped to the exact opposite of what it was in January and February. Now it's being driven by higher inflation expectations, higher rates, and a stronger dollar. So this favors things like domestic equities, large cap over small cap, and sectors like energy and materials. So I think the point is that it's a very dynamic environment. Although, if you had meaningful diversification, you obviously were able to sort of smooth out that ride. So, diversification has already been a tailwind in 2026. And I think that that balance is going to be critical going forward as leadership continues to evolve.
All righty.
Nothing I could add to that. That was beautiful.
Um,
Succinct
I
and
was
That
eloquent.
was well done.